Gold is approaching a major liquidity zone right now, and smart money is absolutely preparing the next move. My primary focus for this explainer is a very precise sell setup engineered specifically around today's NFP catalyst.
The macro bias on gold is firmly bearish. Institutions are heavily distributing at premium arrays, and they've got their eyes locked on one very specific level on the downside. We're talking about the 40-30 sell-side liquidity pool. 40-30.
Now this isn't just some random support level you'd find in a textbook. This is where a massive cluster of resting retail stop losses is sitting right now. In institutional order flow, a level like this acts as an absolute magnetic draw.
Section 1. The Gold Trade Plan and Executing the NFP Sweep.
So here's the exact blueprint for today. Our daily bias remains deeply bearish. The primary setup is a sell, but only after a liquidity sweep. The key entry zone we're monitoring sits right between 40.75 and 40.85, with our ultimate take profit target at that 40-30 sell-side liquidity pool we just mentioned.
The engine for this entire move is going to be the high-impact NFP news hitting at 7:30 p.m. But you have to understand something crucial. To smart money, this event is not fundamental noise. It's a pre-programmed liquidity engineering mechanism specifically designed to sweep stops and build institutional order blocks. Section 2. Smart money liquidity logic and why institutions attack.
The market is sending a massive warning signal right now. Notice the stark contrast here. On the left, the macro daily chart shows a prolonged, aggressive, bearish distribution. Literally every rally gets sold. But on the right, the intraday 1-hour view just shows a minor, weak retracement. And remember, higher time frame order flow always dictates the intraday liquidity draw.
But here's where the fatal flaw in retail logic really reveals itself. Most retail traders are looking at the 40-50 area and blindly buying what they perceive as support. Institutional logic, however, sees those early buyers, calculates exactly where their stop losses are placed, and targets those exact orders to fill their own massive short positions. Those resting sell stops below the 40-30 equal lows form exactly what we call sell-side liquidity. Right now, this liquidity pool is highly vulnerable. It actually represents the true, overarching objective of the current algorithmic delivery.
Section 3. The executable ICT entry model and the NFP trade plan.
So how do we safely execute this without getting stopped out? Well, here's the exact actionable trade matrix. We're looking to sell within the 40.75 to 40.85 premium array. The stop loss goes safely above the structure and validation point, right between 40.95 and 41.05. We'll take partial profits at 40.50 and leave a runner for that 40.30 sweep. That gives us a really solid risk-to-reward ratio of 1-to-3 or better.
But listen, you can't just blind sell the zone. You absolutely have to wait for these strict mechanical steps. First, wait for a buy-side liquidity sweep above 40.70. Second, you need to confirm a clear 15-minute bearish displacement candle. And third, you enter only on the retest of the newly formed fair value gap. I honestly cannot emphasize this enough. Wait, right now there is absolutely no valid institutional confirmation. Selling before the news catalyst sweep actually occurs is essentially trading blind. And honestly, that's exactly how accounts get blown.
Section 4. The Retail Trap, also known as the Judas Swing.
This brings us to a really critical part of the setup, the trap. Ask yourself, where are retail breakout traders getting trapped as we head into the New York session today?
Looking right here at the 15-minute level, you can see exactly where smart money will likely engineer a false upward spike right as the news releases. We call this the Judas Swing. It's designed to drive price rapidly and aggressively into that 40.75 to 40.85 zone to trigger early short stops and trap breakout buyers right before the true institutional move down.
However, every professional setup requires a strict invalidation level. If we see a sustained break and a displacement candle close above 41.05, our entire bearish thesis is completely canceled. At that point, smart money is clearly seeking higher macro liquidity, and we simply step aside. No trade.
Section 5. The final recap and a professional warning.
Let's quickly lock in the final execution steps before the session opens. The bias remains deeply bearish with a very clear institutional target down at the 40-30 sell-side liquidity pool. The trigger is the NFP sweep combined with M15 displacement. And most importantly, strictly cap your risk at 0.5 to 1% per account. High-impact news volatility demands ultimate discipline.
If you appreciate this style of fluff-free, institutional-grade market analysis, make sure to subscribe to this explainer series for more ICT market theory.
And if you're looking for a reliable environment to execute these exact setups alongside smart money, you can find the FXTM account link provided right in the resources for this explainer.
So the board is set, and the liquidity is resting. As those NFP numbers hit the wire, the market is going to force a decision. The only question is, will you fall for the retail trap today, or will you wait patiently and trade alongside smart money?